welcome to the FII View with me, Tanveer Gill. My guest today on the show is Jeff Lewis, Global Market Strategist at JPMorgan Asset Management. He joins me from Hong Kong. Jeff, good to have you on the show. Now, let me begin by asking you about the U.S. markets. The U.S. reported a strong quarterly growth this time around, in quarter two, that is. What is the expectation going forward from quarter three and quarter four? Because there was a bit of a seasonality element for the first two quarters. So how do you see the growth trend going forward?
That's right. I think we'll get a clearer idea, and we have been forecasting for a long time a stronger growth trajectory around 3% in the second half. So there was a good rebound. The fact that the first quarter negative 3% was revised down closer to 2% also helps for the forecast for calendar year 2014. That's still likely to be around 2%. But with a much stronger trajectory in the second half of the year, which augurs well for continued robust growth in 2015. So we're pretty comfortable now with the macroeconomic data, particularly the high-frequency data coming out of the United States.
Right, and what would that mean for emerging markets? Because it would almost be like all boats rising if the U.S. picks up on growth on a sustainable basis.
Well, clearly what happens with the Fed is of great importance. It's probably one of the keys for the emerging markets. It will depend, really, whether we see a continued gradual scenario in which the Fed prepares everybody and inflation remains well behaved and you don't see signs of a big pickup in wages. Then I think this is just one of a number of factors that is going to influence emerging markets. I think you have push factors and pull factors. Pull factors will be an improvement in the performance of the emerging markets, particularly on the corporate earnings front. So it's not necessarily as negative as people sometimes make out. It is something we have to get through. We know it's coming. And we would say probably the sooner the better, because it would tell us the Fed believes the US economy is healthier and stronger. After all, that's the reason why they're going to be raising interest rates.
How do you rationalize the dollar's underperformance so far into the year? Of course, it's changing. Now the dollar is making a bit of a reversal. But do you think that this trade is here to pick up in the second half? We could see the dollar getting stronger as it has over the last 10 days or so?
Well, I think the dollar from this point is likely to start to strengthen. We'll be seeing stronger U.S. growth, stronger than in any other G7 economy except for the UK, and we'll be seeing monetary policy normalizing again faster than anywhere else except perhaps the UK. So from this point onwards, I would expect a firm trend to the dollar, and what we've been seeing in dollar versus euro, gradual weakness for the euro, I think that trend is likely to be extended in the second half of the year.
Also, Jeff, the U.S. markets are at record highs. If the first rate cut comes in, do you think the markets could correct if the rate cut especially comes in earlier than expected?
Well, I think there's always likely to be a knee-jerk reaction and a period of correction. Historically, when the Fed has brought in that first interest rate increase, then Treasury bonds have sold off some 3 to 4 months before that, and there's been a knee-jerk reaction in the stock market as well. What has differentiated the two assets, though, is that Treasuries have continued to do poorly for some considerable time going into the cycle of raising interest rates, but equities have normally recovered quite quickly. So I would expect something similar on this occasion, provided, of course, that inflation is contained and that everybody sees the Fed is in the business of normalizing interest rates, not having got behind the curve and having to therefore raise them faster and more aggressively.
Sure. Then what is the expectation from the Treasuries on the back of a potential rate hike?
That's a good question. I think the market has already moved to discount the fact that the longer-term equilibrium level of interest rates could well be lower than we have seen in the past. If you look at the 5-year forward 5-year Treasury bond, it's around about 3.5%. that would seem to be a reasonable kind of level. Well, what I think we could see is that if there is a burst of stronger data sometime in the second half, then there could be a short-term sell-off and move up in Treasury bond rates, even if the final resting place is lower than historically one might have expected.
The other key question, Jeff, is that does it seem like the U.S. growth is for real, or is there a doubt on the health, the productivity, as also the job market, because they seem to be sending mixed signals?
Well, I think there's two questions there. Productivity performance has suffered, and it's not as good as it was in the past, and partly that's also labor force is growing more slowly. So productive potential estimates from the likes of the CBO, the Congressional Budget Office, have been revised down to around 2%. But there's still a lot of spare capacity with the US economy because of the depth of the Great Recession. So it's quite possible that the US economy can grow at 3.5% for several years before it really needs to slow down to match that slower productivity growth, which you just alluded to.
Fair enough. Let's talk about the European markets. And what is your view on Europe with the low inflation prints that are coming down and slowdown in growth there?
For the euro, we think it's likely to drift gradually lower against the US dollar. It is worrying that we haven't seen much relief on the inflation front. We've seen a continuation of quite low numbers. So the amount of growth that we have at the moment, although there's a recovery, it's a relatively weak one, and it hasn't been enough to move us away from the inflation-deflation danger zone. Encouragingly, though, the latest ECB bank lending survey does look a bit more optimistic in some areas. So we are seeing signs of credit growth picking up a little bit.
Well, despite a strong current account surplus, the euro has been weakening. Is the trend likely to continue?
I think it is likely to continue because the ECB under Mario Draghi is looking to expand its toolkit of unorthodox monetary policies. We think that the targeted LTRO may not be the last in its toolbox, and yet we know that the Fed is of a mind to normalize monetary policy. So there's quite a gap between the two cyclical positions of the US and Eurozone economies, and that suggests that the euro should be continuing to weaken gradually versus the US dollar.
Also, as part of your overall EM strategy, how do the Russia sanctions tie in as a risk?
Well, the Russian economy has experienced tremendous capital flight, but then the central bank does have very, very large reserves. Certain financial areas, certain banks will find their operations more difficult, so the sanctions are not helpful. But the Russian economy is essentially in recession anyway. I think that there will be an end to this at some point and a normalization of relationships. So I think for really long-term investors, the cheaper the Russian market gets, the more they should be looking there for long-term value.
The other aspect, Jeff, of course, has been global liquidity, which was largely fueled by US QE. We are seeing the withdrawal there. Tapering is happening. Could the ECB-infused QE replace a US QE then going forward and thereby fuel the US markets further? Could there be some sort of readjustment as far as flows are concerned?
That's a very good point. I think a lot of commentators, a lot of strategists look to the Fed as the primary central bank that's driving global liquidity. But there's some recent IMF research suggests that global liquidity is in fact global, and that the actions of other major central banks in fueling global liquidity through QE policies are also important, notably the Bank of Japan, Bank of England, and the ECB. So if we look at this G4 central banks, then we're not facing by any means a credit crunch in 2015, and global liquidity conditions could be a lot better than some people are currently expecting.
Fair enough. As part of your EM strategy, where is money being incrementally allocated across emerging markets?
We've just started to see the signs since April of relatively small amounts coming back into emerging market equities, somewhat larger amounts because of stretch for yield, because of the drop in US Treasury bond yields, going into the emerging market debt space again, and hence accounting for the very strong returns that we've seen from emerging markets in the first half of the year. For equities, we are, I think, close to the point where we're going to start to see some improvement in earnings momentum, and that should act as a catalyst to attract increasing portfolio flows into emerging market equities.
Fair enough, but where is the differentiated risk-adjusted value in emerging markets that you're spotting right now?
Well, you do need to be selective. We like particularly the Asian manufacturers leverage to the global economy. Korea looks particularly cheap at the moment. We like Taiwan also, China. We like those which have got a strong domestic story, like India, Indonesia, and we're also quite positive on Mexico.
You know, we spoke about the euro, the dollar's strength especially. What is the view on EM currencies in lieu of that, especially the rupee?
On EM currencies, they overshot last year. They have stabilized. I wouldn't rule out further periods of volatility related to concerns over US interest rates, but I don't think we'll see anything like the plunge we saw in emerging market currencies last summer. They have raised interest rates, they have taken macroeconomic adjustments, and many have seen improvements to their trade and current account deficits. Having said that, of course, it is a volatile asset class.
Let's talk India. Do you think that India's outperformance is likely to continue? The market has returned 22% year to date.
I think there's a very strong story here. There's a very strong domestic story. Of course, the impact of Modinomics on the supply side in India we won't really see that in the data for a number of years, but we are seeing the government's hitting the ground running with an awful lot of measures having been announced. So, and it does appear to be determined to carry its program out. So I think the fundamentals for India do look particularly good. And I think foreign institutional investors are particularly looking at the larger emerging markets, which have a strong domestic side to the story. So from that point of view, of course, the Indian market has run very hard this year. So a correction in the summer months is quite likely. But I think on a long-term basis, the trend is definitely upwards. It's a market we're very happy to be overweighting.
But does it seem like India is more of a crowded trade now because the macros have not been supporting the market move as was expected? Yes, there's been some improvement, but there hasn't been a pickup as one was expecting, especially on the growth side, on the productivity side in the market, in the economy so far. So do you think that the market will largely be range bound, or is there more potential of an upside from here?
I think it is becoming a crowded trade, but then I think economic reality, in the sense of a cyclical recovery, we are seeing upward momentum in industrial production. We are seeing some better numbers, and we've seen some useful declines in inflation, and of course a tremendous improvement in the trade and current accounts. So I think the macroeconomic numbers are getting better, but of course there's a long way to go before India recovers the strong growth trend that investors are assuming Modinomics will lead to. So yeah, there's a lot to prove, but I think the numbers are starting to turn in India's favor. It is a popular trade, but then if it was unpopular, the market wouldn't go up.
Yeah, the key area of interest for India has really been exports, which is why IT and pharma have done well, and the consumption story. Where are you placing your bets in terms of investment ideas?
Well, our Indian fund management team, they take a very bottom-up approach, but they can find value in quite a few sectors. They're looking at domestic cyclicals. Obviously, they're looking at those which will benefit from a revival of infrastructure projects. They're looking for those companies that have got sold down because they didn't have the finance to proceed with many of these projects, and now many of those are in a better situation with regards to securing financing. So there are those kind of stocks, the cement stocks, obviously, but also we're not abandoning the export sectors. We see a stronger global economy. We see stronger markets in the US and Europe, and in particular, I think we're going to see good results also from the IT sector. So basically, we're not making really heavy bets. The other area, of course, that we like is financials.
You know, as somebody who tracks fund data as well, how much money has India got in broad Asia or EM allocations over the last 3 months since the election, and also post the budget over the last, let's say, 3 weeks?
Well, the numbers I've seen suggested about 11 billion year to date into Indian equities, somewhat larger than going into other Asian emerging markets, but not quite as high a proportion as India was attracting early last year, where at some stage it was attracting, on a net basis, 100% of the money going into Asian equity markets. So I would say it's fairly Goldilocks at the moment, not too hot, not too cold. Obviously, if you attract too much money, that also is a problem, and that increases the risk of subsequent sudden outflows. Most of the money coming into India seems to be from institutional investors that are taking a longer-term view, and that money is relatively sticky or, in a statistical sense, persistent.
What is the view that funds are taking on the government policies that have been announced in India so far, whether it's in power, infrastructure, financials? How are FIIs looking at the policy announcements as also the course of implementation for those policies?
Well, I think these are the right sort of policies. Quite a lot of detail was given in Mr. Jaitley's first budget. Some things, like pressing ahead with the goods and services tax, or with raising the FDI limit on insurance, these were policies of the previous administration. So I think Modi-nomics, it's not really about a different political or economic ideology. It's simply about getting things done better, faster, more efficiently, with greater energy. So, so far, this government is impressive with the range of decisions that it has already taken, and with its evident determination to implement policies as soon as possible. What will be critical is how Mr. Modi manages to forge good working relationships with the key state governments for the largest state economies within India.
You know, Jeff, India's average weightage as per the benchmark MSCI is at 6%. Any signs that funds are looking to increase their overall weightage to India, you know, going overweight perhaps?
I think weightings will go up, but it's early days yet. We're only really beginning to see money returning in any size into the emerging market equity space. I think there's plenty of room for it to grow.
Even though there's no direct comparison, how are the flows being allocated or divided between India versus China, where the growth seems to be stabilizing? The data is still mixed. But do you think there is a bit of a rift in allocations in Asia portfolios between these two regions?
Well, I think we'll be seeing investors, foreign investors, putting money into both markets. China, as you say, going back a few months, there was considerable pessimism that growth could continue to deteriorate. Now, of course, we're seeing stabilization. We're seeing better GDP numbers. We're seeing stronger signs of activity. Notably, exports are improving. And we're also seeing progress on some of the key reforms, like the plan for the hukou reform that was announced a couple of days ago. So I would investors are not going to be binary. They're not going to say, oh, it's India or China. They'll be allocating money to both markets.
Jeff, there have been such high expectations from India, especially post the elections and the big mandate that the government has come in with. What do you think can spoil the party for India? What's the key risk at this point? Are there talks about India getting potentially upgraded by rating agencies in the next 12 to 18 months? Do you think that India is pretty much on course on the macro side to achieving that? Or do you still think that India would labor for some more time before getting its act together on the macro side?
It wasn't so long ago that India was facing the danger of a downgrading or a cut in ratings from agencies. I think we're a little way off that point in time where the rating agencies will be thinking of upgrading India. But I think with a government bond market with yields as attractive as 8.5%, 8.3%, and inflation which is coming down, and interest rates which are no longer being hiked, then the problem might be that the Indian government bond market looks too attractive to emerging market debt investors, and that those kind of surges in inflows can also cause problems. But they do, of course, have ceilings. There is a ceiling on the foreign institutional investor limits for access to the domestic bond markets.
Fair enough. Jeff, and finally, is India still in alpha trade despite the 22% year-to-date returns that the market has seen? Is there still more upside?
Yes, we would say so. I think it's looking at how far some of the cyclical sectors had fallen over the last 3 years. They're still in the early stages of recovery. We're still in the early stages of a profits recovery, and we believe that over the medium term, India Inc. could deliver compound earnings growth somewhere between 15 and 20%. So that would validate further performance gains.
Well, thanks very much, Jeff, for joining us with your views on India and global markets. Really appreciate your time as always. With that, we come to the end of this edition of the FII View. I leave you with a quick reaction to the RBI credit policy, the RBI's stance on rates going forward, and also some investment ideas in India.
Well, RBI has been keeping the rates on hold while watching out for the inflation because there has been some concerns about food inflation picking up. We think they are trying to anchor the inflation expectations and i.e. staying ahead of the curve rather than falling behind the curve, because what you don't want to see is inflation expectations running ahead, therefore being forced to tighten more. So I think they remain prudent, which we think is a good sign for the economy. India has done very well this year. The Modi victory obviously boosted investor sentiment. We like the long-term Indian story because Modi reforms will improve the sustainable economic growth rate for India. In the short term, we are somewhat cautious because looking at the valuations, short-term positives are probably reflected. But having said that, there are still investment opportunities for long-term investors who can look through short-term cyclicality and identify long-term growth stories. We actually have been trimming on margin because of the valuations, as India has done quite well this year. We don't invest on electron outcome, rather we focus on long-term fundamentals. So we like the Indian long-term story. We just need to be disciplined with valuations. We are focusing more on stock-specific investment opportunities. All of these sectors offer interesting, long-term growth opportunities, but we are focusing more on stock-specific valuations rather than taking sector calls.